Good morning, everyone. Thank you for tuning in today. My name is Matt Wilson, and I'm the finance officer here at DuPage Foundation. On behalf of our board, our investment committee, and our staff, I'd like to welcome you to today's webinar with our partners at Northern Trust. Before we begin, just a few housekeeping notes. Today's webinar is being recorded and will be made available to all participants after the program. If you have any questions, please use the Q&A feature at the bottom of your Zoom window. We will address them during a segment at the end of the hour. And if you have any questions specific to your fund here at the foundation or need any additional information on today's content, please feel free to contact me at my email address, which I will drop in the chat. Joining me today is David Weiss, Vice President for Finance here at the foundation. And from Northern Trust, we have Marty Morris, Senior Vice President and Portfolio Manager with the Foundation and Institutional Advisors Group. We have Chris Shipley. He's the Chief Investment Strategist at Northern Trust. And we have Eric Williams. He is the Head of Capital Structure and a Senior Portfolio Manager at Northern Trust. So with that, I will hand it over to Marty, and he will take it from here.
Awesome. Thanks, Matt, and welcome everyone to our third quarter DuPage Foundation Investor Update. We've been doing this for a couple of quarters now. I think it's been really helpful to get some education out around kind of what's going on in the economy, markets, and take a look at the main pool of funds that we manage for DuPage Foundation. So with no further ado, we'll just jump into the presentation. Just as a reminder. We are with Northern Trust. We're one of the global leaders in asset management around the world. And Matt mentioned a couple of special guests we have today: Chris Shipley, Eric Williams. And they're going to provide some unique perspective on what's been going on in the markets in 2022. It's been a difficult year in both the economy and markets, and so they'll both bring a good perspective to the conversation today. But just kind of updating everybody on our group at Northern Trust. I am Marty Morris. I'm a Senior Portfolio Manager in our Foundation and Institutional Advisory Group. I get the privilege of partnering with organizations like DuPage Foundation, working with them on their asset allocation and investment programs on an outsourced Chief Investment Officer basis. And Matt, if you could go forward a page. That's actually, let's go one more page. Kind of give everybody that isn't familiar with our FIA group, go to page 6, please. Yep. Yeah. So people aren't familiar with our Foundation Institutional Advisory Group. We are a dedicated nonprofit practice at Northern Trust. We're a national team made up of 3 regions. I'm in the Central region, headquartered in Chicago. And as I mentioned, we work primarily on an outsourced Chief Investment Officer basis, or OCIO. With nonprofit clients around the nation. So who do we serve? Who do we work with? Endowments, foundations, operating nonprofits, and associations. And our client type and assets are listed at the bottom. And we currently have about $15 billion in assets under management across several different categories of clients. And if you go to, I think it's page 9. Yeah, so it's a good segue. We're going to bring in Eric Williams, as Matt mentioned. He's a manager in Northern Trust fixed income team, focuses on the high yield portion of the fixed income market. And again, both Eric and Chris today are going to give some good perspective. So I will pass the baton over to Eric.
Thanks very much, Marty. And yeah, as Marty mentioned, my area of focus has been high yield, and I'll talk a little bit about that today, as it's certainly outperformed this year relative to expectations, and we'll go through why and also our outlook at this time. What do we think at current valuations? But as you think about the content and you think about questions, please don't limit them to high yield. Happy to talk about other aspects of the fixed income asset class. So we can move to the next slide. Yep, one more, please. Thank you. High yield, in our view, has certainly matured over the last 20 years. And particularly this year, it has demonstrated its value-added complement and diversifier qualities to the traditional equity bond portfolio. And that has provided very attractive risk-adjusted returns year to date. So the asset class can really be thought of as the third leg of a diversified portfolio stool. So through high yield, you're getting that important credit exposure, also known as default risk, what you're being compensated for, relative to your traditional stock and bond portfolio that already has market risk and term risk or duration risk, and notably through investment grade bonds or treasuries. So of the three premiums over the risk-free rate, credit risk is actually both higher than market and term. Combined with a very low correlation to investment grade and a less than 1 correlation to equities, high yield provides the asset owner with very strong diversification benefits, of which have been notably realized this year. We consider high yield as the least risky risk asset, and as such, we allocate in this way across our asset allocation committee. So high yield exhibits sharply lower downside capture relative to equities, as you see on the left side of this chart, alongside, of course, its main attraction, which is high income. And at this point, this is incredibly compelling relative to historical periods, and we'll talk through that shortly. It's really that power of the consistent return generation that gives high yield a much higher Sharpe ratio over the long term relative to global equities, as you see on the left. So the unprecedented bear market this year in treasuries has had an extreme effect on high yield returns. If you strip away the impact from rising rates, high yield has actually massively outperformed relative to what we normally would expect its downside capture to be, as shown here. When we think about investing in high yield, we generally consider three facets. The first is corporate fundamentals. The second is generally the technical associated with the market. And finally, that leads us to a view from a valuation perspective. Risks to these views are always present, notably with technicals, as that can change fairly quickly. This year, it has been quite persistent. We'll talk about why. But let's review, I would say, our base case assumptions and why at this time we remain constructive on high yield going forward. You can move to the next slide, please. This is something that has been persistent since coming out of the COVID period, really since the middle of 2020. And that's been the strength of corporate balance sheets and corporate fundamentals. Looking ahead, we do expect the good profitability and strong balance sheets to support interest coverage and leverage ratios going forward. Ultimately, this is going to allow default rates to remain below historical averages. The long-term average default rate for high yield is roughly 3.5%, and as it stands right now, it's about 1.5. While we believe that the low of the default rate is in and behind us, we don't expect that default rate to materially increase over the next 12 months. So despite the credit spread widening year to date, starting from an incredibly low level of roughly 280 basis points to just a touch under 500 today, That has resulted in a yield to worst of about 9%. And default rates, as I mentioned, have not dramatically increased off the all-time lows earlier this year. We believe the reason for this is the strong corporate fundamental backdrop that I mentioned before. The result of that is what you see on this chart. This is the credit quality composition of the high yield asset class. And as you can see, double Bs represent a very high level, more than 50%, relative to the long-term average of 43%. So significant credit enhancement in the form of higher credit quality in the high yield asset class. If you look on the left side of this page, triple Cs, those securities normally associated with very high levels of default, have never been lower than they are today. So this should give investors comfort as they think about what junk status really means relative to what it meant 20 years ago. The asset class is roughly 1.5 to 1.6 trillion, 4 times the size it was as we were going into the global financial crisis. The size of the companies are larger, and also the credit quality is larger. So this is often a major talking point of ours when we're talking to our clients and prospects, that the history of the asset class has dramatically changed and yields itself to a much higher credit quality and thus lower default risk than prior periods. I should note that leverage remains at all-time highs now, and interest coverage, leverage at all-time lows, and interest coverage is at all-time highs. And while that is likely to change over the next 12 months as earning revisions come into effect, we're at such a position of strength right now that we don't expect that materially to increase in terms of leverage relative to prior recessions. So what does that mean? Right now, we're in leverage levels of around 3 to 4 times overall for the asset class. Even in a stressed scenario, we don't believe leverage will increase by more than 1 turn. So call that to around 4 times. That's still 2 times below where we were even at the depths of crisis, or if we go back to 2016, and certainly well below 2008. Just to give a little context around how strong corporate balance sheets are today relative to the debt load. If we can move ahead, please. This is a really interesting chart and is something that I think makes the asset class or fixed income in general incredibly compelling. And that's been the impact of higher interest rates this year. We believe yields look incredibly attractive and now sit comfortably above the long-term average. So while credit spreads have done a good job, arguably an incredible job of absorbing much of the historic rate rise this year, yields better reflect the significant income generation potential from the asset class. Now 250 basis points above the long-term average post the global financial crisis, which is about 6.3%. This point is further underscored when considering the significant quality changes that we saw on the last slide. So when you think about the high yield asset class on a dollar price, as you see here, we've really ended the year at 100 or par. Now it is in the low 80s. And as you see, this is effectively the most positively convex the asset class has ever been, only to be superseded by COVID and all the way back to 2015 during the commodity crisis and growth scare. The major difference between today and that time is the energy sector is now experiencing significant free cash flow generation, and leverage is very low, and there's an increase in management team capital efficiency with respect to CapEx. And so what we expect going forward, if we were to assume a significant recessionary scenario or a hard landing of the like, That default rate that the market experienced back in 2015 is likely to be capped in a significant way in the cyclical parts of high yield, which represent 20 to 25% just in energy and metals alone. So we don't believe the episode that we experienced in 2015 is likely to be repeated, which bodes very well for the total return potential today. And a significant portion of that is driven by this positive convexity, which you see here. Historically, high yield has provided very, very strong total returns over the following 6, 12, and 18 months at a yield above 8%. As of yesterday, the yield is 9.32. So this is another reason, combined with the low dollar price that you see here, that makes us constructive on the asset class going forward. If we move on to the next slide. This is something that I pay close attention to. It is slow moving, but this year we have experienced a very strong technical tailwind, even more so than 2019, which was the prior record. And we've frankly shattered that this year, and the year is not over yet. Over the course of the most, I would say, accommodative monetary policy conditions, frankly, in this market's history, management teams took notice and they did what they were incentivized to do. And think about this very simply like you're a homeowner. You took advantage of low rates and you moved out that maturity or your mortgage into the future. That's exactly what management teams did. They refied all of their upcoming debt at very low maturities, and they pushed that maturity wall into the future. So what you're looking at here is the overall maturity schedule for the high yield asset class. And you can see quite clearly that we don't have a tremendous amount of maturities coming due in 2023 at 56 billion, or 2024 at 76. And to give some context around these numbers, over the last 2 years in the busiest months, we were doing 55, 60, 65 billion a month in new issue. So that is why you have not seen an incredible amount of distress creep into the high yield market, where the market as a whole or its investors are getting uncomfortable with looming maturity deadlines because it frankly just doesn't exist. You may have pockets here and there, but that does not lead to a significant increase in the default rate. So this benign maturity schedule has been incredibly supportive of valuations. And as we think about where the 2-year, the 5-year, the 10-year interest rate are, as shown by the Treasury yields, this is likely to persist over the next 6 months or so until we get greater clarity on the path of inflation. And the second derivative and more important one is the level of Fed funds and monetary policy conditions into the middle of next year. And until we have clarity there, it's likely to persist that we don't have a tremendous amount of new issue, which should bode well from the technical side of the valuation equation. With that, I'll leave it there and hand it over to Chris, and happy to answer any questions as it relates to high yield, investment grade, or broader thoughts on fixed income. Thank you.
All right, sounds good. Thank you, Eric. And I did see that there was one question that came in on high yield that might be answered as I make my way through my presentation, as I'll go through the tactical view. But to set the stage, and I'm going to zoom out a little bit from what Eric has been talking about on the credit side and speak more to our tactical outlook. But just to set the stage, there are 2 different time horizons that we consider. We have our capital markets assumptions process each summer, which constructs what we refer to as the strategic asset allocation. You can see that on the left-hand side. And that represents what we believe to be the optimal asset allocation on a longer term 5+ year basis. I'm sure you've heard of us speak to that before. And then against that longer term strategic allocation, we have shorter term 12-month tactical bets depending on our outlook. on some of the nearer term risks and opportunities, valuation dislocations, et cetera. And so, as you probably know, our strategic asset allocation is set annually, doesn't change by a huge amount every year, whereas the TAA, the tactical view, is set monthly or potentially more often if conditions necessitate. And we walk through those conditions each month and go over where we see the relative opportunities versus that strategic. So I'm going to walk through our current thinking on a tactical basis, as well as highlight some current trends and other considerations that we think are relevant to market performance today. So if we flip ahead a slide, we held our IPC meeting, our Investment Policy Committee meeting yesterday. And so there's actually some minor tweaks to a couple of these slides that I'll speak to as we're making our way through here. But here we have our base case. And the old name on the left-hand side, which is still very applicable, is inflation-focused Fed. I'll talk about the differences and how we're thinking about things now. But on the inflation-focused Fed side, what we're thinking about here is that we have nearly a single mandate central bank. So stable prices and maximum employment are actually at odds with one another right now. And the Fed has made it very clear that their intent is to maintain stable prices and are willing to accept the economic consequences of doing so. They really cannot afford to allow inflation to become entrenched. And they're willing, again, to accept the economic consequences of bringing inflation down to target. And part of getting inflation under control is having credibility, which they do have based on the inflation break-evens, which we'll talk about in a bit. We do see inflation peaking, and we can talk about the data that came out today. The pace of that decline may be somewhat slower than is implied in the break-evens, though the break-evens have been moving up of late. That has brought that a little bit closer to our thinking. We do expect a Fed funds terminal rate that is essentially consistent with where market expectations have been, which is around 5%. But our view is that we could end up staying there perhaps a bit longer. And I think Powell was trying to communicate that last week. So the new language that we're using is the inflation-focused Fed became central bank divergence. And it's very much the same thing, but it's acknowledging that other central banks around the world appear to be pivoting earlier than the Fed. So it looks like the Fed will end up moving rates more than other central banks from here, and that they may stay there for longer. U.S. inflation, while today's numbers are certainly up, certainly pointing in the right direction, it has proven very difficult to bring down. The economy's been very resilient, which suggests that the Fed has more work to do. And there are implications of all of that, particularly when you see this diverging central bank policy, where what we've seen coming out of the Bank of England or the ECB or the Bank of Canada or even Australia is that they seem much closer to a pivot or a pause in rates than the Fed. And so that has implications on currency. It has implications on sentiment as well. So we're acknowledging that as part of our base case. The other portion of our base case, which is global disappointment, remains the same. The Fed's campaign against inflation is slowing the economy by design, as they're attempting to address the demand side, and that certainly creates downside risks to the economy. It creates downside risks to corporate profits. Earnings expectations are starting to move lower. They probably have a little bit more to go, even in a base case scenario. The labor markets have clearly proven to be very durable, which is a challenge for the Fed, as they do need wages to come lower, at least wage growth to come lower. So not a particularly rosy outlook, I would say. You've got the Fed moving aggressively to control inflation, which is going to lead to growth to disappoint. So we're certainly not overly optimistic in our base case. If we flip ahead to our risk cases, and here too, we had a slight change that I'll address. But here we're talking about a central bank mistake, and geopolitical risks is really what we're looking at. And central banks, again, led by the Fed, have moved very aggressively to contain inflation, the speed of which has been necessitated by being late in initiating these interest rate increases. And that's dramatically changed financial conditions in a very short period of time, and came out of a period of exceedingly low rates where most were expecting to be in this quasi-permanent feature going forward, which has certainly created some challenges around the world. We don't necessarily foresee another UK pension crisis or something similar to that, but there's plenty that we can't see. And it's clear that someone is getting hurt by the magnitude with which interest rates have gone up. So it is possible that central banks could go too far, creating something to break as a risk case. Now, we renamed that risk case from central bank mistake to Fed persistence, given that other central banks are seemingly closer to backing off the pace or the level of increases that we expect. So the risk case moves more specifically to the Fed. Geopolitically, we have been mindful of the risk of escalation in Ukraine, where Putin is looking increasingly cornered without a great off-ramp. You can certainly been following the most recent news on that front. China's President Xi has consolidated power and has removed potential dissenters out of the political situation in China, which is paving the way for even more authoritarian rule. It's unclear exactly how that's going to be used, hopefully not in a way that threatens security in the region, but it's something that we're mindful of as a risk case. So if we flip ahead, just in conclusion, we have reduced risk this year. Inflation has certainly proven to be more durable than was expected at the outset. Monetary policy has been therefore more restrictive than expected at the beginning of the year. And the economic implications of all of that, of course, are more material. So we were overweight natural resources in the first half of the year, which worked out very well to protect from inflation. Today, we are underweight global equities with a significant preference for the US, as you'll see in a bit. We are overweight credit versus term risk, so we like high yield, as Eric noted. But overall, our risk exposures, in other words, the amount of risk that we're taking tactically relative to our strategic asset allocation is fairly low. So again, I'll go over the positioning in a bit, but I think it's fair to characterize it as fairly close to home and a little bit cautious. So if we flip ahead one more, I want to chat about a few topical issues. And the first of which, and hopefully you can see this okay, is the implication of rates on equities. And we can speak to this from either the short end of the curve or the long end of the curve. And for the long end, which is not represented on the slide, we know that higher rates are bad for stocks because of the discount rate. And we bring these future cash flows back to present. So the higher the discount rate, the lower the present value. So that's reasonably well understood. And it impacts growth stocks more than value stocks, as more of the value of a growth company is in the future. So again, you increase that discount rate, it's negative. And certainly that's played out this year with growth significantly underperforming value. And then there's the implications of short-term rates, which is what's depicted here. And what we're looking at specifically, the horizontal axis is the 1 year increase in Fed funds. And the vertical axis is the return from 6 months before to 6 months after that rate campaign. The first thing that you'll note is the red dot, which is where we are today, which is the 5% move that we expect over the 1 year horizon. That's unprecedented going back to the mid-1980s that we see on this slide. So we don't have a lot of data points, but it's clear that more rate hikes are bad for stocks, which is fairly intuitive. And if you look at the trend line, if you draw a line through all of those random dots, we're actually essentially on the trend line. So again, all of this makes sense. The Fed is trying to cool the economy, which is bad for growth. It's bad for corporate profits and can theoretically trigger recession. So it's not surprising to see the market reacting negatively. If we flip ahead one more, so typically when we go through our asset allocation discussions every month at our tactical asset allocation meetings, we go through what we call our grid discussion, which is where we look at growth, inflation, monetary policy, fiscal policy. And normally we start with growth. But today we start with inflation, then get to monetary policy, which is ultimately driving growth. And so this chart represents the outlook for inflation. And the top, the realized inflation headline CPI is the dark green line. That's the sticky one toward the top. The falling green line at the top is the 6-month annualized PPI. So think about that as somewhat of a leading indicator of where the consumer prices will go, is what producer prices are doing. And then the lower two lines reflect the 2-year and 5-year inflation swaps. In other words, what's priced into expectations. And as you can see, the market, based on those inflation swaps, is expecting inflation to reach something close to the Fed's 2% target, which is critical for the Fed, as we've talked about before. If you have expectations that inflation will increase in the future, that increases current consumption, which really tends to entrench the problem. So the good news for the Fed is they have the credibility, as evidenced by the swaps curves or the break evens, which means that the market believes that they have the tools and that they have the will in order to see this through. And the will side of it, I think, is what Powell was really trying to communicate last week when going through the outlook for Fed policy, and really trying to indicate that they are willing to see this through to the end, regardless of the economic costs. Now, our view, as I've indicated before, is that the market may be a little bit optimistic on how quickly inflation will fall. We do believe it will fall, just again, perhaps somewhat less quickly, which means that rates could remain somewhat higher at that terminal rate for longer. Now, of course, we do have the CPI report that came out this morning, which came in under expectations, while you had jobless claims that came in line, which is important when you're thinking about this possibility of a soft landing. And I know that that idea has gotten a lot of pushback of late, that there could be a soft landing, and we don't put better than 50% odds on it ourselves. But a recession at this point is certainly not guaranteed. And if you look at the labor market, which is quite healthy, if we can see wage growth start to come down without a large increase in unemployment, which is certainly possible when you consider corporate behavior, companies are going to be reluctant to let a lot of people go in this cycle on what may be a shallow recession, given how challenging it's been to get employees in the door in the first place. And so it is possible that you could see a deceleration in a very significant way on wage growth without necessitating a dramatic rise in unemployment. Meanwhile, the consumer, while the capacity to spend is certainly waning, they are holding up better than many might have expected. Now, this does make the Fed's job harder because it means that the economy is not cooling as quickly, and it means that inflation might be somewhat more difficult to come down. But again, you look at a print like today and you start to see things moving in the right direction. That's certainly a positive. Don't want to overreact to a single data point. But again, more news like today's CPI will certainly be taken very favorably, as you're seeing today, with yields down some 30 basis points at the long end. The S&P 500 is presently up 4.5%, and the NASDAQ up 6%. So again, the falling rate backdrop is certainly positive for growth stocks, as I mentioned before. If we flip ahead one more, this is looking at the equity market returns broken down into fundamentals and valuations. And so the gray line is the forward earnings expectations indexed to 0. The dashed line is the price movement of the S&P, and the green line is the change in valuation. So with earnings up on a forward basis, that implies that more than all of the decline in the market this year has come from valuation. Now, estimates are falling, and we've been below consensus for 2023 earnings. Consensus expectations for 2023 for the S&P have gone from north of 250 now all the way down to 233. Our view of a soft landing earnings estimate is probably around 245. So the consensus has come down to something below the soft landing scenario. We put a shallow recession at around 210 on S&P earnings and are currently using the midpoint for our single point forecast. So that's 228. And so a little bit below the consensus, but the consensus has been rapidly coming our way. So now, if we think about that shallow recession scenario, given the upside that we see in the market today, up some 4.5%, we're now a bit above 18.5 times our shallow recession 210 number, which is above what we consider a long-term fair value for US equities of around 17.5 times. And that even that 17.5 probably needs somewhat lower interest rates in order to justify, probably a 10-year in the 3 to 3.5 range. And so clearly the market at this point, given the optimism that's been embedded in the last handful of weeks, is no longer pricing in recession in our view. So the market is susceptible if economic conditions continue to weaken. But we do think that, again, there is a pathway, albeit a narrower pathway, to use Powell's comments last week, to that soft landing. If we flip ahead again, this is just looking at some of the inflation backdrop relative to PEs. And I think this is just illustrative of, again, of this idea of PEs are sensitive to levels of interest rates. So what this is essentially showing, and I won't force you to go through all the detail here, that lower inflation is good for equity valuations. Essentially, the lower the inflation, the higher you see historical valuations, which again makes sense because as inflation falls, so should rates, and that helps equity valuations. So if we flip ahead and just look at where that leaves us, and as I mentioned, while you do see some fairly notable differences in our tactical positioning versus our strategic, the overall risk position is actually fairly low. So if we look at the fact that we are overweight, we're overweight cash, we're overweight high yield versus investment grade, which has actually worked out year to date, as Eric noted. The higher yield has certainly offered more protection from this significant rate move that we've seen. You know, bonds have not necessarily offered the amount of diversification that you might typically see, just because normally when you have credit spreads widening on economic fears, that's being offset by falling rates. Now you have the economic concerns that are a function of higher rates, so you don't have that same natural hedge. But to Eric's point, you've still seen some nice downside protection coming out of high yield, which is notable just given the amount of increases in interest rates we've seen and how disconnected from historical precedent that is. We are underweight equities with a notable preference for the US. As you can see, we're significantly underweight emerging markets. We're underweight non-US developed markets. And we do have a small overweight to listed infrastructure, as its relative stability tends to do well in higher volatility environments. And so that's something that we do think is interesting as we think about the future of being somewhat uncertain and a little bit more volatile. So that's what I have. I'll leave it there and see what questions we might have.
Okay, so the first one, it looks like for Eric, has or will the asset allocation to high yield change for Northern Trust? And I think it was highlighted a little bit here, if you want to elaborate.
Yeah, the allocations that you see here are part of a robust conversation that we have once a month. The positioning in terms of preference for credit risk over interest rate risk has been one that I think Chris covered well, as we think about the Fed being very focused on fighting inflation. They fight inflation by increasing interest rates. And given how high inflation is and how important it is to ensure that inflation is lower and doesn't come back, a high level of interest rates is likely to persist in 2023. The duration of the investment grade asset class is roughly 2 times that of high yield. There's much lower income generation. And so when we think about the yield on IG versus the yield on high yield, in order to make investment grade a more compelling asset allocation decision, one needs to realize the benefits of the longer duration. You realize longer duration when the entire interest rate curve goes lower, or you see the long end go lower because, as I said, IG is more sensitive to moves in long end rates. Obviously today that is occurring, but we need to see this persist for a significant amount of time in order to see potentially greater return on a risk-adjusted basis from investment grade to high yield. Today is a terrific first step in the right direction. But I would imagine that all members of the FOMC obviously are pleased with the inflation data, but one data point does not make a trend. And we need to see this persist for several months before the market, I guess, gives significant credibility to the fact that inflation is heading back to the long-term target, and most importantly, will stay there, because we know the problems that arise when the Fed pulls off the accelerator and inflation comes back prematurely.
And then one regarding the recent elections. Have the recent elections changed any thinking from Northern standpoint?
I can take that one. So when you think about the midterm elections, there's a lot of discussion around the historical performance of markets around midterms, and generally the year following the midterms is actually a very good year for risk assets. There's several explanations that are often given as to why that is. Typically, when you have a new Congress that comes in, they have some type of pro-growth mandate or initiatives that they're trying to get done. The administration is typically interested in putting up a good year of growth ahead of the next election cycle at the presidential level. So you typically have some favorable market performance in the third year of a presidential cycle. In this situation, we're obviously coming off a period of full Democratic control, and the market had been looking forward to, I think, divided government as we go forward. We don't officially have the results of the election yet, as you well know. The Senate is very much still up in the air. The betting odds have the Senate going to the Democrats again, while the House is favored, I think, 80 to 20 on the betting odds going to the Republicans, but no one has been willing to call that just yet. So if that's true, and the House ends up with a very narrow majority for the Republicans, while certainly not the red wave, it will be enough to basically limit any substantive policy initiatives that would come out of the Democratic side over the next 2 years and would represent a legislative gridlock, which I think is what the market is essentially hoping for. And so we've been less concerned as to whether or not the Senate goes one way or the other, as it's not as market consequential. So long as the House goes to the Republicans, again, you end up in this legislative gridlock. So things that might have come about, like a windfall profits tax for the energy sector, or more burdensome financial regulations, or additional movements toward some type of government-led healthcare, all of those would be essentially non-starters if you end up in a narrow House majority for the Republicans. And so, again, we don't think this is particularly consequential because the fact that the market had placed such high odds on this outcome, and whether it's a 40-seat majority in the House or a 5-seat majority or a 3-seat majority or whatever we end up at, is probably somewhat less market consequential, at least in the near term. There are implications for what this means for 2024. And if you look at the Senate map in 2024, it hugely favors the Republicans, as I think only one Republican is defending a seat in a swing state, whereas there are three. I think there's 3 Democrats that are defending seats in Republican states and 5 in swing states. So the maps is incredibly favorable to the Republicans. That gives them a lot of momentum into the 2024 Senate side. And then we'll see what happens. Clearly, the House could flip back the other way. So we could end up in a period where we're in divided government for at least 4 more years, which from a market perspective, I think is actually a fairly good outcome. So the market is tending to dislike uncertainty. And when you have gridlock, that takes away uncertainty from a policy perspective.
Okay, and if we have no more questions, Marty, can I pass it along to you?
Yep, absolutely, Matt. Yes, we could jump forward. We can take a kind of quick look at the portfolio. This again, it's our main pool of funds that we manage for the DuPage Foundation. Yeah, I just got to, I mean, and Chris did a really good job of characterizing the third quarter. I put a few bullet points on here that primarily have to do with inflation. And as Chris mentioned, that's going to be the key factor that markets are looking at as we go forward. So if we go to forward to the next page. So just to get the bad news out of the way early here, so we put up the third quarter returns for both our risk control, which center around fixed income, and our risk assets, which of course include high yield equities and real assets. So as you can see, for the third quarter and for 2022, we are currently in the worst calendar year performance for a 60/40 portfolio ever, going back in time, and ever is a long time. But it's also important to keep in mind that this is just on a calendar basis. There have been periods in time, if you look from a peak to trough basis, not kind of excluding the calendar year, we're in the 6th worst period of performance for the 60/40 portfolio going back in time. So what we're going through this year is unusual, but it's not unprecedented. I think that's important to keep in mind. And Chris previewed also that performance coming out of periods like this, where we've had more than 10% drawdowns in 60/40 portfolios, have been well above trend. And I say this all the time, starting points are important. And so starting where we are with valuations and where the markets are, if you have a longer term point of view, which we do for the perpetual portfolio for DuPage Foundation, the expectation is that returns on a forward basis are going to be above trend versus what we've seen over the past year. So going to the next page. Yeah, I thought I'd put some perspective around some of the volatility that we're seeing in 2022. So here on the top, we've laid out the number of days where there's been plus or minus 1% moves in the market. And you can see 2022 is really approaching the volatility that we saw back in 2020. And you have to go back to the global financial crisis in the late 2000s to find another period of time aside from COVID-related volatility we saw in 2020. The next page, we look at fixed income. It has been a historically weak year for fixed income securities. And as you can see on the top chart, through the end of the third quarter, fixed income returns are down 16%. We had a max drawdown of 17, much worse than any period of time going back to the great financial crisis, which goes into the negative returns we've had on the diversified 60/40 portfolios. It's the other leg that unfortunately was down in 2022. Next page. Again, kind of recapping, Chris covered a lot of this, but just from a portfolio positioning perspective, we are overweight cash. We very much think of cash as a lower duration portion of our fixed income portfolio. The other bonus portion of having an allocation to cash in a down market, apart from helping out on the relative performance, is it gives us some optionality as we look forward in the back half of 2022 and out into 2023. We'll have the ability to allocate those cash funds into risk control assets or risk assets opportunistically, and that's how we look at that slight overweight in the cash portion of the portfolio. And the next page. So this is a current snapshot of what the asset allocation was at the end of the third quarter. So as advertised, it's important to note, we do have a slight overweight to US equities in the portfolio, and maintaining a small underweight to developed market equities and a larger underweight to the emerging markets. On the fixed income side, we are underweight investment grade fixed income. That is offset to some extent by a slight overweight currently in high yield securities, but all in as a fixed income portion of the asset class, we are slightly underweight. On the alternative side, Chris talked about our favoring global infrastructure as an asset class. We do have a slight overweight in global listed infrastructure. We have brought the commodities back to an equal weight. Our hedge fund position is equal weight, and we are in line on the private equity side in DuPage Foundation's portfolio. And the next page, I know these numbers are sometimes small and hard to read, but I would focus everyone's attention to the middle of the page, where we have the year-to-date performance of the DuPage Foundation main pool. On the top of the middle of the page for equities, equity performance year-to-date down just under 26% at 25.94%. Fixed income performance down 13.85%. Again, it's a combination of investment grade and high yield. And the relative bright spot from an asset allocation perspective, at least for this, for DuPage Foundation, is that we do have positive performance on the alternative side, again, primarily coming from the private equity performance that we've seen year to date. So all in, net of fees, the portfolio year to date down 16%. Again, that's about 50 basis points better than the custom benchmark we have set up. It's always a small consolation to be outperforming in a down market, but I think that goes to show the diversification efforts we've made in the portfolio and some of the portfolio construction changes we've made to position the portfolio for the weakness we've seen in markets. Always important to kind of think about the diversification we've made in the portfolio. The bottom line on the page has the kind of the naive 60-40 passive benchmark. So year to date, a 60-40 portfolio down north of 21% to 21.25%. Put that into perspective for the diversified portfolio we have for DuPage, only down 16%. Again, kind of showing the benefits of diversification in 2022. On the next page, it's a couple of comments on the fund level. So some changes we've made in the portfolio more recently that I'd like to highlight. So the addition of Coho partners on the value side. Value has been a relative bright spot in the down market year to date in 2022. On top of that, Coho as an active manager has actually beaten the benchmark. So we've added value in two ways, with the allocation to value as a style and to Coho as an active manager that has added positive alpha in their category and asset class on a style basis. On the next page, on fixed income, I would highlight our position in DoubleLine. DoubleLine has been a relatively good performer on the fixed income side. They're an active manager and have benefited from the slightly lower duration posture of their portfolio in the fixed income asset class. On the alternative side, on the next page, just to kind of look at private equity, since it has been a relative bright spot. So private equity returns. It's important to remember that private equity is always reported on a lagged basis. So the returns you're seeing here are mark to market through the end of June. We have not got any more recent marks, and so important to also keep in mind that private equity tends to lag returns in the public markets. So we've seen weakness in the public liquid markets year to date in 2022. We have yet to see that that negative performance come in on the mark to marks we've seen on the private side, but we are anticipating that we'll get some lower marks as we get through the end of this year and into 2023. So that's all I had for prepared remarks on the portfolio. I guess maybe again it's a good place to pause, see if there's any questions about our portfolio construction or performance.
Okay, we don't have any new questions. So if anyone has any questions, please feel free to submit those in the Q&A. Happy to answer. Okay, if we have no more questions, I think we can wrap this up. As you wrap up, I do want to thank Chris, Eric, and Marty for taking the time out of their day to join us today on the call. Thank you to David, and thank you all for participating. We will upload a replay either later today or at some point tomorrow. And if you have any questions, please feel free to contact me at Matt@DuPageFoundation.org. Thank you again, and have a good day, everyone.